What if I told you the difference between a losing trader and a consistently profitable one is just 3 minutes? Not a new strategy, not more indicators, just 3 minutes that can completely reset your mind and change your trading forever. Most traders enter the market believing that success comes from predicting price movements, finding the perfect strategy, or mastering technical indicators. They spend countless hours studying charts, backtesting systems, and searching for that one edge that will finally make them profitable. But what they fail to realize is that the real battle in trading is not happening on the screen, it's happening inside their mind. Before you ever click the buy or sell button, your mental state has already determined the outcome. If your mind is clouded with fear, you will hesitate, miss opportunities, or exit trades too early. If you are driven by greed, you will overtrade, ignore risk, and hold positions longer than you should. And if frustration takes over after a loss, you will fall into the trap of revenge trading, trying to win back money quickly instead of sticking to your plan. This is why mastering your mind must come before mastering the market. The market itself is neutral. It doesn't know you, it doesn't care about your trades, and it doesn't act against you personally, yet many traders behave as if the market is attacking them. They take losses personally, they feel emotional highs after wins, and they let these emotional swings dictate their next moves. This creates inconsistency, and inconsistency is the fastest way to destroy a trading account. Tom Hougaard emphasizes that the difference between losing traders and winning traders is not intelligence or strategy, it is emotional control. Professional traders are not free from fear or doubt, they simply know how to manage it. They don't allow a single trade to affect their mindset, and they don't let emotions interfere with their execution. Think about it this way, even the best strategy in the world will fail if the person using it cannot follow it consistently. A trader might have a system that works 70% of the time, but if they panic during losses, skip valid setups, or take impulsive trades, that edge disappears. The strategy didn't fail, the mindset did. When you learn to master your mind, everything changes. You begin to see the market clearly without emotional distortion. You stop chasing trades and start waiting patiently for high-quality setups. You accept losses as part of the process instead of reacting to them. And most importantly, you develop the discipline to execute your plan over and over again, regardless of short-term outcomes. This level of control doesn't come overnight. It requires awareness. You must become conscious of your thoughts and emotions while trading. Notice when your heart rate increases, when you feel the urge to act quickly, or when you start doubting your plan. These are signals that your emotions are taking control, and this is where the power of a simple pause comes in. Taking even a few minutes to step back allows you to reset your mental state. It gives you the space to detach from the immediate pressure of the market and reconnect with your strategy. In that moment, you shift from being reactive to being intentional. Mastering your mind means understanding that you are the biggest variable in your trading performance. The charts don't change because of you, but your perception of them does. When your mind is calm, you make better decisions. When your mind is disciplined, you follow your plan. And when your mind is strong, you remain consistent even when the market is not. At the end of the day, trading success is not about beating the market, it is about mastering yourself. The idea of a simple pause may sound insignificant, especially in a fast-moving environment like trading where every second feels important. Many traders believe that stepping away even briefly means missing opportunities. But in reality, the inability to pause is exactly what leads to poor decisions, emotional trades, and unnecessary losses. The power of a 3-minute pause lies not in what you do during that time, but in what it prevents you from doing. Trading is an emotional roller coaster. One moment you're confident after a winning trade, and the next you're frustrated after a loss. These emotional swings create a cycle that most traders get trapped in without even realizing it. After a loss, the urge to win back money quickly can lead to revenge trading. After a win, overconfidence can push you to take bigger risks or ignore your rules. Both situations are dangerous, and both are driven by emotion rather than logic. This is where the 3-minute pause becomes a powerful tool. Instead of reacting instantly, you interrupt the cycle. You step away from the screen, even if just mentally, and give yourself the space to breathe. This small action creates a gap between stimulus and response, and in that gap lies control. Without it, you are simply reacting to whatever the market throws at you. Tom Hougaard often emphasizes that the key to consistency is not eliminating emotions, but managing them. You will feel fear, you will feel greed, you will feel frustration. These are natural human responses. The problem is not the emotion itself, it's what you do when you're under its influence. During those 3 minutes, your body begins to calm down, your breathing slows, your heart rate stabilizes, the intensity of the moment starts to fade. What felt urgent just seconds ago no longer feels as overwhelming. This physiological shift is critical because it directly affects your decision-making ability. When you are in a heightened emotional state, your brain prioritizes speed over accuracy, leading to impulsive actions. When you are calm, your brain can process information more clearly and logically. But the pause is not just about calming down, it's about regaining awareness. It's a moment to ask yourself honest questions. Are you following your plan, or are you chasing the market? Are you taking this trade because it meets your criteria, or because you feel the need to act? Are you in control, or are your emotions driving your decisions? These questions bring you back to reality. They remind you that trading is not about constant action, it's about calculated action. And sometimes the best decision you can make is to do nothing. Many traders underestimate how much damage can be done in just a few impulsive minutes. A series of emotional trades can wipe out hours, days, or even weeks of progress. On the other hand, taking 3 minutes to reset can save you from making those mistakes in the first place. The pause also reinforces discipline. Every time you choose to step back instead of reacting, you strengthen your ability to stay in control. Over time, this becomes a habit. You no longer feel the need to jump into every move. You become more selective, more patient, and more focused on quality rather than quantity. This is what separates professional traders from amateurs. It's not that professionals see something different in the market, it's that they respond differently. They don't let emotions dictate their actions. They create space between what they feel and what they do, and sometimes that space is just 3 minutes. In a world where speed is often seen as an advantage, the ability to pause becomes a hidden edge. It protects you from yourself, it keeps you aligned with your strategy, and most importantly, it allows you to trade with clarity instead of chaos. In trading, there is a constant battle happening between discipline and impulse. Every trader, no matter how experienced, feels the pull of both. Discipline is quiet, patient, and structured. It follows rules, respects risk, and waits for the right moment. Impulse, on the other hand, is loud, emotional, and urgent. It pushes you to act now, to chase the market, to take trades that were never part of your plan. The difference between a losing trader and a consistently profitable one often comes down to which of these forces wins in critical moments. Most traders already know what they are supposed to do. They have a plan. They understand their strategy. They know their entry points, their stop losses, and their targets. But knowing is not the problem. Execution is. And execution breaks down the moment impulse takes control. Impulse shows up in many forms. It appears when you see the market moving fast and feel like you're missing out. It whispers that you should jump in, even though the setup isn't there. It shows up after a loss, convincing you to take another trade immediately to recover what you just lost. It appears after a win, telling you to increase your position size because you feel unstoppable. In all these moments, the decision feels justified, but it is not disciplined. Tom Hougaard teaches that the market rewards discipline, not emotion. A disciplined trader does not act based on how they feel in the moment. They act based on a predefined plan that has been tested and proven over time. This means taking trades only when the criteria are met, managing risk consistently, and accepting outcomes without emotional interference. The challenge is that impulse feels powerful. It creates a sense of urgency that is hard to ignore. It makes you believe that this trade is different, that this opportunity won't come again, that you must act now. But in reality, the market is full of opportunities. There will always be another trade. Acting on impulse is not taking advantage of opportunity, it is abandoning discipline. When you choose discipline over impulse, everything begins to change. You stop overtrading because you are no longer chasing every movement. You become more selective, focusing only on high-quality setups. You accept losses as part of the process instead of reacting emotionally to them. And most importantly, you create consistency in your actions. Consistency is what builds long-term success in trading. It is not about winning every trade, but about executing your strategy the same way over and over again. A disciplined trader can have losing trades and still be profitable because they manage risk and stick to their plan. An impulsive trader, on the other hand, can have winning trades and still lose money overall because their actions are inconsistent. Choosing discipline is not easy. It requires awareness and control. You must recognize the moment when impulse is trying to take over. It often happens quickly, a sudden urge to act, a spike in emotion, a feeling of urgency. In that moment, you have a choice. You can follow the impulse or you can pause and return to your plan. This is where mental strength comes in. Discipline is not about being perfect. It is about making the right choice in difficult moments. It is about saying no to trades that don't meet your criteria, even when it feels uncomfortable. It is about sticking to your risk management rules, even after a series of losses or wins. Over time, every disciplined decision strengthens your ability to stay in control. It becomes easier to resist impulse because you have built the habit of following your plan. And as this habit grows, so does your consistency. In the end, trading success is not determined by how smart you are or how advanced your strategy is. It is determined by your ability to execute with discipline, especially when it matters most. Because in the moments where impulse is strongest, discipline is what protects you from making the decisions that can cost you everything. One of the most overlooked truths in trading is that you cannot control what you are not aware of. Many traders believe they are making rational decisions following their strategy and acting with discipline, but in reality they are being subtly influenced by emotions they haven't even recognized yet. This is why awareness is so powerful. It is the foundation of control. Before you can manage fear, you have to notice that you are afraid. Before you can stop overtrading, you have to recognize the urge that drives it. Before you can stay disciplined, you have to become aware of the exact moment when you are about to break your rules. Without awareness, you are simply reacting on autopilot, repeating the same mistakes again and again. Tom Hougaard often emphasizes that the biggest shift in trading performance comes when a trader starts observing themselves as closely as they observe the market. Most traders analyze charts in great detail, trends, patterns, levels, but they never analyze their own behavior with the same level of focus. And yet their behavior is the one thing that directly impacts their results. Awareness begins with paying attention to your internal state while you trade. Notice your thoughts, notice your emotions, notice your physical reactions. Maybe your heart rate increases when a trade moves against you. Maybe you feel tension in your body when you are about to enter a position. Maybe your thoughts start racing after a loss, pushing you to take another trade quickly. These are all signals, and they are incredibly valuable if you learn to recognize them. When you develop this level of awareness, something important happens. You create space between what you feel and what you do. Instead of immediately reacting to an emotion, you observe it. You acknowledge it, and in that moment, you give yourself the opportunity to choose your response. For example, imagine you just took a loss. Without awareness, you might instantly feel the urge to jump back into the market to recover your money. This is a common reaction known as revenge trading. But with awareness, you catch the urge as it arises. You recognize it for what it is, an emotional response, not a logical decision. And because you see it clearly, you are no longer controlled by it. This is where control is born. Control does not mean eliminating emotions. That is impossible. You are human, and emotions are part of the experience. Control means not letting those emotions dictate your actions. It means staying aligned with your plan, even when your feelings are pulling you in a different direction. Awareness also helps you stay grounded during winning streaks. Many traders lose money not after losses, but after wins. Success can create overconfidence, leading to larger position sizes, riskier trades, and a false sense of invincibility. Without awareness, this shift happens unconsciously, but when you are aware, you notice the change in your mindset. You see the confidence turning into overconfidence, and you can correct it before it leads to mistakes. Another powerful aspect of awareness is that it allows you to learn from your actions. When you are fully present and conscious of your decisions, you can reflect on them more effectively. You can identify patterns in your behavior, what triggers your mistakes, what situations cause you to lose discipline, and what helps you stay in control. This self-understanding is essential for growth. Over time, awareness becomes a habit. You start to catch yourself earlier and earlier in the process. What once felt automatic now becomes intentional. You are no longer driven by unconscious reactions. You are guided by conscious decisions. And that is the real edge in trading, because the market will always be unpredictable. Prices will move in ways you cannot control. But your response to those movements, that is entirely within your power if you are aware enough to take control of it. In the end, awareness is not just a skill, it is a shift in how you approach trading. Instead of trying to control the market, you focus on controlling yourself. And when you do that, you move from being reactive to being deliberate, from being emotional to being disciplined, and from being inconsistent to being in control. Most people think consistency in trading is built through big breakthroughs, finding the perfect strategy, catching massive winning trades, or having a streak of profitable days. But the reality is much simpler and far more demanding. Consistency is not created in big moments. It is created in small, often invisible decisions that you make every single day. Every trade you take, every trade you skip, every time you follow your rules or break them, these are the moments that shape your long-term results. The challenge is that these moments feel insignificant when they happen. Skipping one rule might not seem like a big deal. Taking one impulsive trade might feel harmless. But over time, these small decisions compound, and that is what determines whether you succeed or fail. Tom Hougaard teaches that professional traders focus on execution, not outcomes. They understand that they cannot control whether a single trade wins or loses, but they can control how they behave in each moment. And it is this repeated behavior, this consistency in action, that gives them their edge. Think about it like this. If you flip a coin once, the result is random. But if you flip it hundreds of times, patterns begin to emerge. Trading works in a similar way. One trade means nothing on its own, but a series of trades executed with discipline and consistency can produce reliable results over time. The key is not trying to win every trade, but ensuring that you are doing the right thing repeatedly. This is where small moments become powerful. It's the moment when you decide to wait for your setup instead of jumping into the market out of boredom. It's the moment when you stick to your stop loss instead of moving it further away to avoid taking a loss. It's the moment when you take a break after a losing trade instead of trying to recover immediately. These decisions may seem minor, but they are the building blocks of consistency. The problem is that most traders focus on outcomes instead of process. They judge their success based on whether a trade was profitable rather than whether it was executed correctly. This creates a dangerous mindset. A trader might break their rules and still win a trade, which reinforces bad behavior. Or they might follow their plan perfectly and still lose, which leads to frustration and doubt. Over time, this confusion makes it harder to stay consistent. True consistency comes from shifting your focus. Instead of asking, "Did I make money on this trade?" you ask, "Did I follow my process?" When you prioritize the process, you remove the emotional attachment to individual outcomes. You start to see each trade as just one step in a larger sequence rather than a make or break moment. Another important aspect of consistency is acceptance. You must accept that losses are part of the game. No strategy wins all the time. There will be drawdowns, losing streaks, and periods of uncertainty. But if your decisions remain consistent, your results will stabilize over time. Inconsistency, on the other hand, amplifies losses and makes recovery much more difficult. Consistency also requires patience. The market will always tempt you with opportunities, but not all of them are worth taking. Waiting for the right moment can feel uncomfortable, especially when you see price moving without you. But disciplined traders understand that missing a trade is far less damaging than taking a bad one. Over time, these small, disciplined decisions start to compound. They build confidence not because you are always winning, but because you trust yourself to do the right thing. You no longer rely on luck or hope, you rely on your ability to execute consistently. And that is what separates professionals from amateurs. Amateurs chase big wins and quick results. Professionals focus on small, repeatable actions. They know that success is not about one great trade, but about hundreds of well-executed ones. In the end, consistency is not something you achieve overnight. It is something you build moment by moment, decision by decision. And once it becomes part of who you are, trading is no longer chaotic or unpredictable. It becomes structured, controlled, and sustainable.